Joining me now is Evan Lucas, Chief Market Strategist at InvestSmart. Evan, good morning to you. Thanks for joining us. The Australian Manufacturing and Services PMI is out today. What's that expected to contain?
It is indeed, Pete. Unfortunately, it'll probably be the first month of 2019 that we actually see contraction in manufacturing. Manufacturing this year has actually been booming. It's quite an interesting thing to be saying, considering what you hear probably, quite a lot about the economy. Manufacturing's been all right, but it looks like for the first time this year it will contract, and that's what Commonwealth Bank is forecasting from their numbers today. It's not surprising considering that we have seen a really, really big slowdown in consumption, and most of our manufacturing that we do here is a consumption product. It tends to be things like apparel. It also tends to be things like small and electronics that we produce. Services continues to expand, but it is slowing. So services expectations are around about 52.5, which is okay. It's actually a slight pickup from September. But again, being a services manufacturing economy, we need to continue to see that to strengthen. And that would probably, again, show why the RBA is doing what it's doing with cutting rates, why confidence is the way it is, why business confidence is the way it is. Unfortunately, the two areas that really drive us are slowing down to levels that are slightly uncomfortable.
I tell you what, it's lucky we've got housing at the moment, isn't it, Evan? Kicking the economy along. Meanwhile, it looks as though debt is serviceable at the moment, according to the latest report.
It is, Pete. Again, the word serviceable is an interesting one because, yes, we can service that level of debt. The question is whether or not it's actually, therefore, a good thing for the household. So the latest report shows that the ability to service the kind of mortgages and the kind of household debt that Australians hold, which is at some points about 190% of income, it is serviceable because rates are low. It is serviceable because overall, although wages aren't moving at a level that we want them to, they are slightly growing. The catch that's happening with this, and as you said, housing is certainly booming, is that in the last 4 months, the movement, particularly in Sydney and Melbourne, has been astonishing. It's the kind of levels that we saw at the start of the housing-led recovery through 2013 and 17. Some suburbs in Melbourne and Sydney have moved up 25% in that period. So it does actually create a little bit of an alarm that we're getting, again, the kind of bubbliness that we saw at the end of 2017. There is certainly, if you listen to real estate agents, they are saying some housing is being bought well and truly over what they're worth. So, yes, we can service the debt. Yes, it does, it is a longer-term idea for people doing it, but people are paying a significant premium for their housing, and the housing that's on market at the moment is not what you would call quality that you probably saw at the peak of the market. So again, yes, we can service it, but it's whether or not you actually get the investment return over 10 to 15 to 20 years that you live in it, and whether or not you're actually putting yourself under pressure you don't need to.
Just casting your mind back a little bit, Evan, the last housing boom, what was that when it's peaked 2017, 2016, yep. 2017? What was the rest of the economy doing, if you recall? And is there a chance of, it's all cyclical, these things, the next housing boom, whenever it comes, could it be as large?
Probably not. And so, yeah, going back to 2017, the economy was, at that point, was probably the period where it was the highest chance of actually seeing a rate hike in Australia since 2011. So there was growing signs that inflation may actually start to materialise as wages finally broke out of a very, very sort of bottoming trend. We started to see wages growth at around about 2.3, 2.4%. That's fallen away. You'd also seen confidence in Asia pick up. The US-China trade war hadn't technically started when this sort of was moving on. If you look at equity markets, they were also peaking out. And you were showing in the international markets, monetary policy was starting to actually tighten up. So the US had started tightening its rates. Even the European Central Bank was talking about tightening rates. So globally, things were moving in the right direction. We here in Australia were moving in the right direction. Housing had certainly been a massive part of that. The other thing that hadn't happened yet was that the changes to foreign investment in housing wasn't into sort of law yet. So you had seen a lot of Asian investment coming into Australia. So all of that was peaking. So that's where you got to in 2017. So in answer to your question now, those changes, particularly to foreign direct investment, will probably not have the same level of upward pressure that we could have in the next one because they are different. There is a lot more tax around that investment. You are obviously going through a US-China trade issue, being the fact that it is our largest trading export partner in China. You've also seen a slowdown in Japan, which we forget about is our second largest trading partner. So they've slowed down. The investment there is slowing. Therefore, the flow through to wages is a little bit slower. Probably the stimulus this time has been those 3 cuts we've seen in 5 months, and the possibility of seeing a 4th one sometime in the next 6 months is also probably hyping the current movement. But can you see it jumping like we saw for those 4 years from 2013 to 17? Probably not as soon as it is right now. Things need to sort of transition through. We need to get past a lot of the global issues, a lot of the current malaise that unfortunately we discussed at the start of this, which is that services are slowing down, manufacturing is starting to contract. So that's probably the next wave to really get that kind of, real upward movement we saw for those 4 years.